And welcome everybody to Gentlemen of Action, your channel that covers finance, business, self-improvement, and crypto news and events, and always to always keep you in the action. My name's Armando Cuervo, and you probably noticed that I haven't really uploaded in about a week, but that's because I'm recovering from a sports injury, guys, so if I'm a little slow or maybe just seem like I'm a little tired, just forgive me for a little bit. But let's get into the news here, guys, because I know why you're here. It's because you probably heard that there was a Federal Reserve interest increase or interest hike. So let's get into the news. So, as per reported by MarketWatch, Fed raises interest rates for the first time in 4 years and plots a series of hikes to fight inflation. Subtitle: War in Ukraine will boost inflation and hurt U.S. economy in the short run, central bank says, as in the Central Bank of the United States. The Federal Reserve on Wednesday, which was March 16th, 2022, raised its benchmark interest rate by a quarter percentage point and laid out plans for a more aggressive strategy of ongoing increases in the months ahead to combat high inflation. With inflation running a 40-year peak, the Fed is shifting aggressively away from its 2-year-old stimulus stance that cushioned the economy during the pandemic. And by cushion the economy, that means that they printed money out of thin air in order to buy mortgage-backed securities and other securities such as bonds in order to prop up the stock market. Now, good or bad, whether you're for it or against it, that's what they did. And to me, that probably helped you a lot if you were in the stock market or, invested that way. But if you were not invested, this basically meant that this high inflation took away the value of your money. So if you kept your money under a mattress or in a shoebox, you may not have been so well off. But I digress. Let's continue. The Fed now sees its policy rate hitting, the Fed now sees its policy rate hitting not 1.9% by the end of this year, jumping to 2.8% in 2023 and staying at that level in 2024. Rates at 2.8% would start to dampen economic growth according to Fed calculations. And no kidding. They're basically saying that they're going to go from near zero to 0.25% to 1.9 by the end of this year, approximately. And then they're going to go all the way up to 2.8%. Now, not financial advice. I'm not a fortune teller. I don't know what's really going to happen. But I feel like we're not going to get to 2.8% by the end of next year. That's my opinion, but stranger things have happened. Maybe it'll even go up faster. But let's continue. The Fed's inflation fighting medicine was stronger than many on Wall Street had expected. Sure. The Fed threw down the gauntlet as it confronts a broad inflation upsurge, twinning a widely expected and tame quarter point rate hike with a much sterner message about what lies ahead. Okay, so they're basically saying that, they're going to start off slow, but they're going to increase it almost every meeting in order to make sure that inflation goes under control. In so many words, that's what they said. Skipping over some of the fluff here, it says here, Powell said that the Russian invasion of Ukraine could hurt the U.S. economy in the short run and is already putting upward pressure on inflation due to higher oil prices. Which, do note, oil prices is the current boogeyman that they're going after because we all get gas and we're all at the gas pump and we see the increases go up pretty quick. But remember, if you saw a video from a week ago, I also mentioned that the Ukraine and Russia, they do other things besides just oil. They do car parts, they do wheat, they do sunflower oil, they do a lot of things over there. So we're basically saying that, yes, oil is going to go up, but there's more being caused by this invasion that's not just oil. We're talking about food prices too. But let's continue. The conflict is also likely to disrupt already strained global supply chains, a big source of the rapid increase in prices, and that could delay a slowdown in inflation until later in 2022. So they're already setting us up to say that, Putin did it. Yeah, this war, that's what's causing inflation. Not at all the monetary policies that they've been doing. They're saying, it's that damn war. If not for that war, we'd be just great. Which, lies. Anyway, I guess I would say the expectation still is that inflation will come down in the second half of this year. Yeah, right. But we still expect inflation to be high this year. Well, at least he's being honest there. At least that's what Powell said. Yeah, Powell was at least being honest there. And going through a little bit more of this fluff, it says right here, the economy, meanwhile, is seeing downshifting to 2.8% growth rate in 2022, which they believe that the economy, with all this that's going to happen, that we're still going to have almost 3% in growth year over year, which, I mean, I guess when you start off from a low point because the economy was shut down for a while, it stands to reason that you're going to have higher growth year over year because you're still starting from a lower point. And it's still not that good, honestly. Going through some more fluff, let's go here. The Fed funds and balance sheet. The Fed did not give details of how it will shrink its balance sheet, meaning all the mortgage-backed securities and bonds that they bought during their stimulus stage, meaning money printing and quantitative easing. They haven't given any real details of how they're going to actually reduce the amount of their holdings. And let's stop right there. So, what does this all mean? What can we learn from this? Basically, the Fed is raising interest rates because they want to fight inflation, because they're saying that the economy is overheating. I don't think it's really overheating. I think that we just have a runaway inflation problem because we're printing a lot of money. And yes, the war doesn't help. I'm not going to say that the war is not doing anything, but we can't say that this all happened because of a conflict that started less than 2 months ago. That would be disingenuous. And what they're trying to do is say that we're going to be really stern by bringing it up to just under 2% by the end of the year. What we can learn from this is that probably in the short term, you will not notice that big of a difference, because Market Watch also did another article right here, which I'm not going to go into too many details because there's a lot of minute details here. But basically, what does 25 basis points, which is point or a quarter of a percent, because remember, when they say basis points, they're basically saying 0.01 of a percent, meaning 0.25 basis points is 25 cents or a quarter of a percent. So it says here what that means for your credit card bills, savings, car loans, and mortgage repayments. So when they raise interest rates, it affects all those things, because your credit card has a certain amount of interest that they charge you plus whatever the Fed is charging. So every time they raise the interest rates here, or the Fed has a hike like this, that increases the amount of your debt, which means that the more debt you have, the less favorable it is for you. Now, one of the examples that they give is that you have a loan for $5,000, which if you're carrying a balance of $5,000 at 16.44% interest, or APR, it says right here that over the life of that loan, you paying $250 monthly payments, you're going to be paying, before the rate hike, you would have been paying $884 in interest. But with the quarter percentage being put in there, you're now going to be paying $900 over the course of the loan, or over the course of the life of that loan or the balance. Now, that's only a $16 increase. That doesn't sound like much, and I agree. $16 over probably the year and a half that you're going to be paying on this is not really that much. But here's the thing. You put in another 25 basis points increase. What happens is it makes it now that you're paying $917 in interest. That's an additional $32. And if you go through the full bore of 1.5% interest that they're probably looking to do, again, they're estimating 1.5 instead of 1.9 for some reason. They're saying that this would equate to an additional $101 in interest payments that you would not have otherwise done if the percentage hike was not put in there. Now, one would say, Armando, it's just $101 over a year and a half. What's the big deal? What can you do with $101, especially over that time? That doesn't mean much. But the thing is, you didn't have to give $101 to your credit card company or your car company or a loan servicer. That could have been your $101 to put into cryptos, into stocks, or even keeping it in savings would have been better because that's your money that you're giving up. So what we can learn from this particular article, which I didn't go into too much detail, it's just telling you everything that happens when a rate increase happens. The short answer is everything goes up in price. So what we can learn from this is that now is probably a good time to focus on paying down your debt before these rate hikes start nickel and diming you everywhere. So basically, if you have a credit card, you may want to go ahead and pay it down pretty quickly before you start paying more in interest, especially if it's a multi-$1,000 credit card. If you owe $5,000 on that credit card, like this is saying right here, you're probably going to be paying an extra $100 or $200 when you don't need to. And that's in the long run, because I'm pretty sure some of us don't pay $250 a month towards a $5,000 credit card. Some of us pay the minimum. Now, of course, if you're watching this channel, you probably watch other channels, and I'm pretty sure that you don't pay the minimum. You try to keep your balances down, and you try to be financially responsible. But what is a good time to do, and this is not financial advice, this is not any advice, I think this is just common sense. It might be a good idea to start paying down your balances and your debts while you still can before it becomes a little bit more expensive. Because the sooner you can pay that off, the more money that you can save long term that then you can be using for your future investments. Because why give an extra $100, $200, $300, $600, whatever it is, to a credit card company for things that you bought that you're not making any money with? Pay that stuff down so then you can start saving money in the future. Don't take away your future money from your future self when you can be making your future self rich by sacrificing a little bit today. Because I know we all sacrifice, but sacrificing a little bit today will save you a lot of money in the future, and you can use that towards your future investments. That's the takeaway. I'm pretty sure that's common sense for a lot of us, but I think it's now even more important to make sure that you have lower debt, because these rate hikes, they make debt more expensive. And the last article I'd like to present today is presented by the Wall Street Journal, which is titled, Saudi Arabia Considers Accepting Yuan Instead of Dollars for Chinese Oil Sales. Subtitle, Talks between Riyadh and Beijing have accelerated as the Saudi unhappiness grows with Washington. Wait, people are pissed off at us? No, that never happens. Let's continue. Saudi Arabia is in active talks with Beijing to price some of its oil sales to China in yuan, people familiar with the matter said. A move that would dent the US dollar's dominance in the global petroleum market and mark another shift by the world's top crude exporter towards Asia. Cool. It says here, the talks with China over yuan-priced oil contracts has been off and on for about 6 years and have accelerated this year as the Saudis have grown increasingly unhappy with decades-old U.S. security commitments to defend the kingdom, the people said. When they say the kingdom, they mean the kingdom of Saudi Arabia, because it's still a kingdom. Anyway, the Saudis are angry over the U.S. lack of support for their intervention in the Yemen civil war and over the Biden administration's attempt to strike a deal with Iran over its nuclear program. Saudi officials have said that they were shocked by the precipitous, it says, U.S. withdrawal from Afghanistan last year, which that was a cluster if we ever heard it. But again, love it or hate it, this is what happened, okay? So, China buys more than 25% of the oil that Saudi Arabia exports. And this is why Saudi Arabia gives a damn about what China's telling them, okay? If priced in yuan, those sales would boost the standing of China's currency. The Saudis are also considering including yuan-denominated future contracts known as the petro-yuan, which that's basically just another word for the petrodollar. That's a term. Look it up. It's kind of interesting how that works. But they're looking to make the petro-yuan and put this in the pricing models of Saudi Arabian oil company known as Aramco. Continuing on, it says that it would be a profound shift for Saudi Arabia to price even some of its roughly 6.2 million barrels of oil a day of crude exports and anything other than dollars. The majority of global oil sales, which is around 80%, are done in dollars. So that basically means that 4 out of every 5 sales that are done for oil are done in our currency. And the Saudis have traded oil exclusively in dollars since 1974. So that's over 40, almost 50 years, guys. And this was a deal made by the Nixon administration. That's why they do it. Okay. So that's a whole lot of stuff to take in. But here's the deal. China does a lot for the Kingdom of Saudi Arabia. They actually talk many paragraphs about what China has done, what they've introduced, why the Saudi prince cares so much about it. And this is basically saying that Saudi Arabia is getting pissed at us, and because of that, they're going to go and find somebody else to be friends with. That's, in so many words, what they're kind of saying. Now, I know that sounds kind of elementary or sophomoric, but I'm basically saying that foreign policy does a lot of stuff, because they're indicating here that one of the things that they don't like is that that the current administration said in a 2020 campaign that the kingdom should be a pariah for the killing of a Saudi journalist. Now, I don't believe that somebody should have been killed or anything, but I'm basically saying that they're taking notes of everything that we say, and it's kind of important. And it also says here that the U.S. economic relationship with the Saudis is diminishing, because we basically went from about 2 million barrels of Saudi oil a day to about 500,000 barrels a day. So we've been dropping the amount that we've been importing. So we are basically losing more of a stake in Middle Eastern oil. Now, you probably don't want us to go and buy Middle Eastern oil, and I agree. I believe we should be energy independent. But that's a different discussion for a different day. So here's the important parts. And because there's a lot of information here that just says, hey, China is good with Saudi Arabia, and they think we suck, meaning the United States. But here's the important parts that I want you to take away from this article, which is that, number one, the Saudis still plan to do most oil transactions in dollars. Okay? And it says here, but the move could tempt other producers to price their Chinese exports in yuan as well. China's other big sources of oil are Russia, Angola, and Iraq. Okay, so basically they're saying that that China can buy the oil and then send it to Russia, and this can bypass the whole sanctions problem, so this has other ramifications. It says here, the Saudi move could chip away at the supremacy of the US dollar in the international financial system. Right, because if they're not going to use our dollar, which is used for a lot of petroleum exports or transactions, that kind of matters. And because the supremacy has been there, this is what Washington has relied on for decades to print treasury bills it uses to finance its budget deficit. And there you go. That's the biggest kicker. Besides that, also here, the oil market, and by extension the entire global commodities market, is the insurance policy of the status of the dollar as the reserve currency. And if that block is taken out of the wall, meaning the fact that we are the global reserve currency, the wall will begin to collapse. What can we learn from this? So, first off, the US dollar is the global reserve currency for a reason. It's because a lot of countries, even though they all have their respective currencies, for example, Mexico has the Mexican peso. Well, China has the yuan or the RMB, whatever they choose to use that day. They may transact or do business with each other, but when they ask, hey, how much does this cost? China's not going to ask Mexico, oh, how many Mexican pesos does it cost? They're going to say, well, how much is it in USD? United States dollar. And because they transact in dollars, they need to use a bank to get the money, wire the money, lock the money up in a bank over in Mexico. They then get the product, and then the money is held because it has to go through a bunch of transactions. So our global economy, our financial system, actually depends that a lot of people use the dollar to do transactions, and that preserves the strength of our currency. That's what it means to be the global reserve currency. And it's because a lot of people have trust that the dollar will hold value, meaning that they believe that the United States will always pay its bills. So because they've always had that faith, at least for the last 50, 60, 70 years now, our dollar hasn't had as much inflation. or hasn't been as affected as other countries where their currency has basically been shot. For example, Venezuela's currency has gone way down because, well, besides the fact that they're communist, there's also the case that no one transacts in Venezuelan pesos. So what can we learn from this again? Is that the fact that somebody else is trying to become the world global currency, the reason they're doing this is because, one, they're pissed off at us. So that's a nice way of saying it. But there's also the fact that because we are printing money over and over and over again, we are devaluating the value of our dollar. People do not believe that the dollar will hold its value. So now they're going through what's called de-dollarization, which means that they're trying to get away from the American dollar and then find another new reserve currency. We've been seeing this with El Salvador, where they made Bitcoin a legal tender. And the thing is, legal tender means you can transact legally as freely as you want. But the reason why El Salvador wanted to get out of the dollar and go into Bitcoin is because they saw that we were just printing money like it was water, or effectively it was a bunch of Pez in a Pez dispenser. So what you should be doing here is probably looking into assets that would continue growing with the amount of inflation that we're probably going to get if the dollar starts to devalue. Because unfortunately, the dollar is devaluing this because they're printing out money like it's going out of style. So what I do is I try to buy multiple things. Yes, I do buy some stocks because typically stocks will always go up in value, because if money is going to be inflated, there's going to be more physical money out there, then that means that possibly stocks, ETFs, precious metals, and cryptos are more likely to go up too, because those are hedges against inflation. Now, which ones in particular to choose, that's for you to decide and do your due diligence on, because honestly, I don't know everything either. I'm taking my best guess. And there's a few cryptos that I'm personally invested in that I believe are going to go ahead and do that. I personally have a few companies that I am invested in because I think it's going to beat inflation. Maybe I'll release it sometime in a Patreon or do something like that, saying what I personally do. But your goal here is that if you know that the dollar is going to be devalued, look for ways to hedge against that and to find ways that your wealth is not attached exclusively to dollars. Because if you're keeping your dollar inside of a savings account, you might be losing money pretty soon. And that's unfortunate. By the way, if you like what I do around here or wish to support me and what I do, please check out the description below on ways to do just that. If you like me to talk about anything in particular, leave me a comment and give me a subscribe. And until then, I'll see you in the next video. Stay in the action, my friends.